Here's some legal loopholes for your age pension and superannuation that you should be aware of.
All right, let's go. What are they?
Let's go. Mate, look, I want to kick off today talking again about deeming rates and how income from account-based pensions are assessed. This one blew up pretty big in the comments section of a video a little while ago. We did a bit of an explainer on it, but it still seems people don't quite get it, and we still get a lot of questions on it. So I'm going to hit that one first, and we'll roll on from there.
All right. So what does that actually mean, and how does it work?
Yeah, look, really good question. So, look, I said a couple of things in the prior video that maybe were a bit controversial. People took as controversial. I said that deeming rates for most people don't matter. And I said that income from account-based pensions is not assessable by Centrelink. And there's a few people that wanted to challenge that one in the comments. And look, I stand by it. And I'll explain why I stand by it. And also, this is really good information because, you know, people often make bad decisions in structuring their superannuation to chase a bit of extra age pension, and often under a misunderstanding of this rule exactly. So first thing I want to hit here is, as I said previously, the income that you choose to draw. And this is if you move your superannuation from where it is now, an accumulation account, and you put it into an account-based pension. Now, there's a bunch of different ways to tackle retirement. This would be the most common that we see. People will move their superannuation to an account-based pension, draw an income.
How much? So if I'm taking money from my superannuation, so I'm over 60, I've retired, I've created an account-based pension. So usually if you're at this stage, you'll have two accounts. You'll have a accumulation account and an account-based pension account. Sometimes you'll just have just a pure pension account, but sometimes you'll have both. And you're taking either the minimum 4% or you're maybe taking more. It's up to you.
Yep.
And that's coming at you. A common question we ask is when does it get paid? How does it get paid? It's your money. You get to pick. So what day did you use to get paid, like from work?
Yep.
It's like, you know, it's the 20th of the month. Cool. So 20th of the month, boom, that's your fortnightly. Boom, that's just what you get. So that's just a little trick that I do with my clients.
Yeah. Now, this is where people get concerned because they think, all right, well, now I'm drawing an income from my super, and maybe I've decided that I want to take an income of $50,000 a year. So I might decide, you know, I've retired now, I've got my account-based pension set up, and I want to draw an income from that account-based pension of, say, I want $1,000 a week, for argument's sake. I'm going to take $52,000 a year out of that income stream. People get concerned that, is this now going to be $52,000 a year of income that's going to be assessed against me when I apply for the age pension? And the answer to that question is no. And this is the one that a lot of people got hung up on in the last video. And it's when you actually stop and think about the reasons why, and I'll explain it in a minute, it actually makes sense that this is not assessable income. And the reason it's not assessable income, despite the fact we call it an income stream and you're receiving an income, is because it's actually a return of your capital. And to put that in context that people probably understand, if you think about, if I put $100 into my bank account and a week later I withdraw that $100, I've not received $100 of income. I've just drawn $100 of my own money. And the principle is exactly the same with your super. I might have put $400,000 into an account-based pension. If I want to draw $52,000 a year out of that, that is just me withdrawing my own money. That is not income that I'm receiving. Therefore, it is not an assessable asset or not an assessable income for Centrelink age pension purposes.
But just to clarify again, I mean, I don't want to talk around book here, but talk to an advisor as well if you're doing this. Like DIYing is okay, and this is the specific rules. Yeah, we'll just give the caveat of seek advice as well.
Yeah,
but
look, okay, so there is, and you know, an account-based pension account is still assessable under the income test, but the way they apply the income test is not the income you're drawing out of it, as we've just explained. The way they apply the income test is deeming rates, which is probably what you've seen on the news recently when they've just increased, and we've got a lot of panic phone calls. And as I said in the last video, 100% of the people I spoke to didn't actually impact them at all. But to give an explainer, so to give a bit of an explainer around how the deeming rates would apply in that scenario, just say for argument's sake, myself and my wife retire, we're both pension age, and between us, we've got $500,000 in super. We've chosen to draw $52,000 a year out of that income, out of that super to fund us. That $52,000 a year is completely ignored by Centrelink for income test purposes. So we don't even have to think about it. What Centrelink are going to do is they're going to look at the balance of our superannuation, our account-based pensions, any financial investments we have, and they're going to apply what we call the deeming rates. And the deeming rates are an assumed rate of interest that they just assume that we're getting. And the reason they do this is because, you know, most super funds are invested in a range of assets, shares, property, all sorts of stuff that goes up and down. If we had to report the fluctuations in the income you're actually receiving, it'd be a nightmare. You'd be on the phone every 3 days because markets move around. The value bounces up and down. So they just give these rates of interest. They assume that everybody is earning regardless of the investment. And at the moment, it's 0.75% on the first party savings, 2.75% on the remainder of your savings. So for a couple, it's about the first 106,200. They assume you're earning 0.25% income on, bugger all. What's that? About 700, just under $800 a year. They're assuming that you're getting an income. Then the remainder, everything over that is assessed at 2.75%, which again, still a pretty low rate of return. You should be earning a lot more than that on your super. If you're not, do something about it. But what that means is, in my example, if I've got a $500,000 combined super balance, myself and my wife, then Centrelink are assuming that, we're getting a total of about $416 worth of income off that investment, regardless.
So that's what's, just to clarify, that's you. Yeah, that's just to clarify. You're actually not earning that. That's just what Centrelink assume you're earning.
Correct. That's right.
So if you do nothing, if you put money in the bank account, like we had a client who came in who didn't want to pay any tax on anything, they are still assuming you're earning that money.
Correct, whether you are or not. So for most people, you got things set up right, you should be earning a hell of a lot more than that. So it's actually a pretty cool test. This is an advantage for you, the way the deeming rates work. So in that scenario, $500,000 of assessable assets, they're assuming about $416 worth of income against us as a couple per fortnight. The allowable limit for a couple per fortnight before our pension starts to reduce is $380 of income. So we're over that limit, only by a little bit, and we're losing 25 cents, each member of the couple, 25 cents in the dollar for everything over that. The wash up of all that is under the deeming rates, we're losing $9 a fortnight of pension. Why I say in most cases, nearly everyone I spoke to, it made no difference. The deeming rates are completely irrelevant to them, is because under the assets test, we're already losing $50 a fortnight. So they're going to apply the assets test anyway. The income test's actually completely irrelevant. Hopefully that helps clear up some of those misconceptions, but to really hammer the point home, the income you draw from your account-based pension is not an assessable income for Centrelink purposes. They'll apply the deeming rates, pretty generous limits. You're probably good. Make sure you're earning more than 2.75% on your money. Now, caveat here, and probably leads into another cool legal loophole, is that there are some types of income streams that are treated differently. Things like lifetime annuities or lifetime income products that some super funds are starting to offer. They do have an assessable amount of income from them, but they're assessed differently. So these types of products, and cool loophole here, if you're someone that's on the borderline of that assets test and maybe not quite getting some pension, but close, you can look at something like a lifetime annuity or lifetime income stream, and they are actually only assessed on 60% of their value. So this can be a good way to bring your assets back under that assets limit if you're pretty close to the borderline.
Yeah, I'm just going to pull up a common question. People say, well, hang on a second. What's that? What's the lifetime annuity? Is this safe? Is this which one do I use? How does it work? And the umbrella term is that it's just a structure. So a lifetime annuity is a structure. There is several different product providers underneath it that offer them.
Yep.
But what Phil is talking about is it's an option that you can take at a high level. At the level down, you can Google it. There's lots of lifetime annuity providers on the internet that you can look at. And some of them offer different levels of, say, safety, should we say, or security. Some will lock your money up perpetually. Some will give you a 5-year turnaround. There's a range.
Yeah.
So,
and there's all sorts of like really new ones that super funds have brought out that are super complex, and get advice before you touch anything.
Yeah, well, I'm trying to stop. I'm trying to have us not talk our book too hard here, Phil.
Well, no, but it doesn't have to be from me. It could be from anyone. But my point is, they're super complex products. Don't go in them with your eyes. Your eyes.
Yeah. But at a high level, it's just a structure, and you should actually do it. I see a lot of people say, "Oh, yeah, okay, that sounds great," and you see some people like, "This is actually be a really good fit for you," but they just go, "Oh, it's a little bit too much stuff, and I have to lock up my money for 5 years." Well, look, let's just put it in a conservative account anyway.
Yeah.
Well, yeah, I can, but like you're leaving money on the table on that concept. That's sort of that's.
You need to look at it in the context of the Centrelink uplift. So with those type of products, only 60% of the asset value is assessable. Once you get to 85, it drops to 30% of the asset value.
Let's go.
So that can be a big benefit. The income from those is assessable. It's not deemed. It is assessable, but only 60% of the income you're drawing is assessable as well. So that would be the exception. As I said, we might do a future episode on that. That's probably getting a bit deep. But look, that's deeming rates out of the way. That's account-based pensions out of the way. I feel like I've flogged that one to death now. But hopefully we've gotten a bit clearer on what that means and how they work.
Phil, Hey guys, it's Scott here. I'm actually editing this video and I am aware how ridiculous my hair looks. I've just been wearing a hat all morning, as I have been right now. So sorry about that. Again, comment section, please. You don't need to text me about it. I'm aware. I'll try to do my hair better for our next podcast. But I know, I see you. I see you commenting. Fine.
Yeah.
What happens if I've got a spouse that's 15 years younger than I am? What happens then?
Yeah.
I want to crack my superannuation egg over, and he or she might still be working.
Yeah.
What do we do?
Great question. It's my favorite bad joke to trot out, but probably, this one takes a bit of future planning, but one of the best financial planning or Centrelink strategies you might be able to come up with is finding a younger spouse. Yeah. It sounds dumb, but it works. So this is another cool legal loophole. Does require a bit of future planning, but if we think about that scenario that you just put to me, so we've got a younger spouse. I say I'm 67, I've hit age pension age, but my wife's only 61. Centrelink does not assess any money that is sitting in my wife's accumulation super account until she reaches age pension age, or vice versa, wife, husband, whatever, another member of the couple. So that gives us actually a pretty cool opportunity to maybe think about how we've structured things and pick up a bit of an age pension uplift. Just think about a scenario where, there's myself and my wife. I'm 67, she's 61. We've got a combined super balance of 800,000, 600,000 in my account, 200,000 in hers. And we know that the asset test limit, or where they start to reduce our pension eligibility for a couple, is $481,500 if you're a homeowner. So I'm over that limit because I'm now 67. I've got 600,000 in super. That's an assessable asset that puts me over the age pension assets test shade out. So I start to get my age pension reduced. I'm 67. I'm allowed to withdraw from my super. My wife's 61. She's allowed to put money into her super. We also know that her super is not an assessable asset. So if I draw those couple of things together, it tells me that maybe I need to be considering ripping some money out of my super, putting it into my wife's super, and it disappears then from assessment until she reaches age pension age. So we've got two different scenarios here. Scenario one is if we did nothing. So I leave the 600,000 in my super, my wife continues with the 200,000. And what we can see is that under that scenario, assuming my wife's not working in this scenario, we're not worrying about income test in this example, I'm eligible for about $16,500 per year age pension. Now, by a very simple strategy of just shifting a bit of money out of my account and over to the wife's account, you can see in scenario number two, I've actually now qualified for the full age pension. So I've gone from 16,000, just over 16,000 to just over 23,000 a year. And that's going to continue for 5 years until my wife hits age 67. So, free money just for holding stuff in a slightly different way. Bloody good strategy if you've got access to it. Which leads me to another legal loophole that people maybe aren't aware of, and that is Jobseeker payments. So a lot of the time we see in these scenarios, perhaps if we do have an age gap, maybe both members of the couple want to retire at the same time. And if I use that same example, where I was 67, my wife's 61, I've retired, maybe my wife wants to retire as well. Like contribution that you have to do, or the work that you have to do to meet the test to qualify for Jobseeker is much more flexible between the ages of 55 and age pension age.
Really?
Yes. So there could be an opportunity in that scenario for my wife to actually go out and get on Jobseeker payments without having to be out, punching out 6,000 resumes a week and looking for work.
Any idea why they changed? Why they did that? Why they made it easier?
I think just to recognise the fact that it can actually be harder for older Australians to get into work. I think that age bias is a real thing out there, and it can be more difficult. So I think there's probably a recognition there that maybe it's not fair to be accepting people to be out hunting for work when they're not likely to get it anyway. And another really common scenario is, quite often it might be someone that's been a housewife for a really long time and maybe doesn't have the skills to get into the workforce at that particular time in their career, or like I say, it could just be that it's difficult to find a job when you're in your 60s. So once you're over 60, you can actually meet the activity test by doing 30 hours a fortnight of volunteer work. So this could be a really good opportunity. If you can't necessarily find work, but you want a bit of extra income, you're happy to go down and, work at the salvos or something like that for 30 hours a fortnight, that can be enough to qualify you for Jobseeker payment.
Does it have to be registered charity? Like do you know the requirements for that?
It's a good question. So Centrelink's guidance on that is you should check with us if it's going to be volunteer work to make sure it qualifies. Now, if it's a registered charity, it's probably going to qualify, but there might be other things that you could do by exception that you could apply for them to approve as volunteer work. But that potentially, like the max Jobseeker payment's like $726 a fortnight. So that's an extra good chunk of money that could be rolling into your household through doing some volunteer work. 55 to 59, the rules are a little bit different. If you've been on Jobseeker for less than 12 months, it needs to be at least 15 hours of, you can only make up 15 hours of that 30 a fortnight through volunteer work. The rest needs to be sort of paid work or something like that. But once you've been on the payment over 12 months, it gets a lot easier. So volunteer work, study can qualify as well. So there's a number of different ways that, don't mean you have to be out door knocking and handing out resumes everywhere, that you might be able to bring some extra money in. It's another little cool tip to know about that a lot of people aren't aware of.
So I just want to clarify, because I just look for it. So it can be a charity or a not-for-profit or a community organization. So it doesn't have to be exact charity. It can be a community organization or a not-for-profit. So there's a range of government agencies that are considered not-for-profit. If you're over 55, you can actually do a combination of both as well. You can do some voluntary work and some paid work. You just need to hit those hours. Again, you'll be able to check it on the website to see exactly what it looks like. And it's probably worth speaking with Centrelink because they'll be able to give you that guidance, but you can actually do a little bit of both just to get those hours up.
Yeah, exactly right. And if you've been on the payment for less than 12 months, you actually need to qualify.
Great. Nice one.
Well, on the topic of work-related stuff coming into retirement, another super cool thing that a lot of people aren't aware of is the work bonus. So the work bonus is actually pretty cool as well, because it's quite common we talk to people maybe not quite ready for full retirement, still want to do something. And often people are then weighing up, well, okay, if I go and do a bit of work, I'm actually going to lose some age pension. Is it actually worth my time once I get the pension reduction to go and do that work? Or am I better off to just not worry about it?
Yeah. So the headline for that is, it is literally a work bonus for those who are taking the age pension, but it's a benefit to keep working. So it's an incentive for you to keep working and also keep receiving a bit of the age pension.
Yeah, 100%. So the work bonus is actually pretty cool. What it means in its very simplest terms is the first $300 a fortnight of income that you earn is actually ignored under the income test. Now,
Right.
It has to be through personal exertion. This is income from work. It doesn't count towards investment income, deemed income, anything like that. It's purely income from work. So that means I can go on a $300 a fortnight that is completely ignored for age pension purposes. That's cool. But another cool thing which came in a little while back is that you actually get a starting bank as well. So you start with a $4,000 bank. What that means is if I earn more than $300 in a fortnight, I can actually still offset further income by using that bank. So to give you an example, I've retired, hit 67, I'm on the age pension, kind of bored, want to go do something. So I go and get myself a part-time job down at the big green shed, everyone's dream retirement job. And say I'm earning $400 a fortnight for that. The first $300 of that income is ignored because I get $300 every fortnight that I can earn that gets ignored. Now, I've still got $100 from that fortnight now that is technically assessable income. But because I've got this leave bank or this work bonus bank of $4,000, that extra $100 comes out of the balance of the $4,000. So now I've got $3,900 left in my work bonus bank, but the full $400 is completely offset until I've used my full $4,000 bank.
That also accumulates forward as well.
It does. It accumulates forward. So if you haven't used that $300 every fortnight, it continues to accumulate until it reaches a balance of, I think it's 11,800 at the moment. Yeah. So that's actually an awesome benefit.
That's 11,800 you can earn up to.
Yes. Yeah. The bank can build up to. So, yeah, a really cool little benefit and a nice way to be able to still do a bit of work, earn a bit of income, but also not lose any age pension from it. So really nice way to...
To clarify again, you need to be over the age of 67 for that to kick in. What we'll do with a lot of our clients is we'll say, you might have your main job. So you might be in your current profession, you're pretty stressful in your work, you know it. And then there's a bit of, something, look, I'm done. I need to retire. I'm done. They hang into their 67. They turn 68, 69, and they go, well, Bowls Club needs someone to pour beers. Yeah. So I can't, they're paying me. But what do I do here? Is it going to affect? No, it doesn't. It's in those perfect examples of, if you do some gardening, if you can do some paid childcare work, whatever it is, it's usually unrelated to your primary profession from before. That's what we see happens quite often.
Actually, that's a good point that you raised too. You do have to be 67 to be able to use the work bonus. And why that's relevant is, if you think about a previous example where younger spouse. So if I'm on the age pension and I qualify, but my spouse is still working and they are under 67, they do not have that work bonus. So every dollar of their income will impact my age pension entitlements.
Yeah.
Or every dollar over the threshold. So that's a cool one. All right. Probably enough talk around the income side of things. Let's have a chat about assets. There are ways to reduce your assessable assets. for Centrelink purposes. You need to weigh up the benefits and the pros and cons of doing this. You are giving up money, therefore giving up earning capacity on that money and those sort of things. But, as I mentioned before, if you're a couple and you own your home, any assets you have over the value of $481,500 are assessable under the assets test. Now, that is everything that you own, excluding your family home. Now, for every $1,000 worth of assets you have above that limit, you will lose $3 per fortnight of age pension. So if I'm $10,000 over that limit, so I've got $491,500, I will lose $780 of pension a year. So all that tells me is for every $10,000 worth of assets I can get rid of, I'm going to get an extra $780 a year in pension.
Great.
I can't just go and give a bunch of stuff away. Centrelink have thought about that and they've planned for it. So
you also got to, you'll be very careful about coming up to pension age, giving stuff away as well.
Yeah, exactly right. And it's a common question that we get, look, my kids are going to inherit this money anyway. Can I just give it to them now and then get more age pension? No, so unless you've planned it very carefully. If for argument's sake, I was 3 years before turning 67 and I gave my kids $100,000, when I apply for the age pension, Centrelink are going to ask me the question, have you gifted any assets in the last 5 years? Yep, gave away $100,000. That's what they call a deprived asset. And they will still assume that you have that asset for a period of 5 years from the time that you gave it away. So now you don't have the benefit of that money anymore. You're not earning on it. You can't draw on it, but you're still getting impacted for your pension. So you need to be careful.
It's also good planning of if you're going to retire in 5 years' time to then, So, okay, we're 6 months and 5 years away. Okay, this is the point we want to look at potentially some gifting.
Yeah, that's right. So planning that stuff out can really help. But if we think about the scenario where maybe we didn't have the forethought or the money or whatever, we didn't plan that forward, what can we do to improve our age pension entitlements without running afoul of any rules? So there's a few things. You can actually give some stuff away. It's just subject to limits. So I could gift $10,000 per year up to a maximum of $30,000 within a 5-year period. So for the first 3 years leading up to retirement or in retirement, maybe I give my kids $10,000 a year over that first 3 years. That gets $30,000 off my assets test limit because that's okay. That's within the rules of what I'm allowed to give away and not impact my pension. So that's one way of doing things.
So say, for example, you're a retiree, you've got 2 kids, you can put $25,000 to help them towards a house deposit. That's going to get up to 50. The first 10,000 is fine. The other 40 is treated as their assets for the next 5 years.
Yeah. So you'd have to plan that out. 10,000 per year is the max. So, a couple of financial years, you could chuck them a bit each and away you go. As long as you don't go over that 30,000 within a 5-year period. So that's one thing you can do. Another thing we've spoken about is the fact that the family home is not an assessable asset for age pension. So if I've got renovations or I need some stuff done to the house that I've been wanting to do for a while but haven't wanted to spend the money, maybe coming into age pension eligibility is the time to do that. For argument's sake, I needed a new kitchen and I pulled $50,000 out of my superannuation and I spent that on my kitchen. That is now that $50,000 has disappeared from being an assessable asset.
Correct.
Now I might need to show Centrelink where it went and that I actually did some renos. They might want to see some invoices, whatever. But spending money on the family home does remove that from being an assessable asset to a non-assessable asset. I wouldn't say to go and do stuff just for the hell of it, but if it needs doing anyway, that's probably the time to be thinking about spending the money.
And you could potentially argue that it adds value to the principal place of the property as well. So, $50,000 renovations might add $50,000 to the value of the property.
Yeah. And then another way you can reduce your assets legally is through a funeral bond or prepaid funeral. So a funeral bond is simply some money that goes into an investment and it's set aside, and the person that receives that bond on your passing away is the funeral director to pay for your funeral. Or a prepaid funeral could be that you've gone to a specific funeral director and you have paid them a lump sum of money to provide for your funeral. Now, when you're considering those things, there's a few things to think about. If you take out a funeral bond, the maximum it's just over $15,000, $15,750 that is exempt from assets test exemption. So that's a way you can get rid of 15 and a bit grand and make sure your family's not going to have to worry about paying for your funeral when the time rolls around. Important to note that limit it's just one fixed limit, whether you're a single or a couple. So you don't get a double bite of the cherry if you're in a couple. It's just that limit. Yeah. Now, a prepaid funeral actually doesn't have a limit on how much can be not assessed, provided there's a contract with the funeral director and stuff. So, You know, if you wanted to have a fancier funeral, that might be something you'd think about, but consider the risks there too. A funeral bond is held with an insurance company and can be paid to any funeral director anywhere, versus a prepaid funeral is with one specific person. If that company goes bust, which has happened in the past, there goes your money. So you need to weigh that up carefully. But
And in the sales pitch, they'll tell you how safe it is.
Yeah,
I'll be like, oh, no, it's all blah, 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 blah.
Yeah.
But just be remembered. Okay.
It's happened before.
Yeah.
So it's just something to consider in your decision-making process, but that can be another way to shield some assets. So I did a bit of a quick worked example about pulling a few of these things together to give you a bit of an idea. But if you think we're a couple and we've got assessable assets of $681,500 for the eagle-eyed out there, you'll notice that I just basically increased the lower threshold by 200 grand to make the math easy on me. So we're over the assets test lower threshold by $200,000. Which means that we are losing $600 a fortnight of age pension entitlements due to the asset test as a couple. So if I go and spend 50 grand on some renos on my house, I go and put 15 grand into a funeral bond, and over the 3 years before getting to age pension age, I've given 10 grand a year to my kids. I've gotten rid of 30 grand through gifting. I've now reduced my asset test by $95,000. So that's giving me an extra about $315 a fortnight, or sort of nearly $7.5 grand a year additional age pension, just by shifting those few things around, which I was going to do anyway. It's just smart timing and doing it the right thing. So another cool way to reduce your assessable assets, get a bit extra pension.
I just want to just touch on a couple of things, and then Phil, I've got a question for you. It's in relation to gifting. If you give, it's not just cash. If you sell the car to your kids for $500 and it's maybe worth a lot more than $500, Centrelink does not like that. So they will probably try and value it at market rate. Maybe you run the risk of maybe if the car's worth 30 grand and you sell it to the kids at 21 grand, maybe you get away with it that way. There's a bit of maybe flex on that one, but if you're doing something really silly of, a peppercorn, like literally like sell it to them for $1, then you're definitely going to get in trouble. So be mindful of that. Interesting enough, if you got any crypto, we have had a few of our 70-year-old clients with crypto. So good on you for holding it. That's also considered a gift as well. So it's not just cash or property. It's literally any type of asset.
Yeah, that's right. They call it a deprived asset, anything that you've given away for less than market value.
What a term. Now, Phil, is there anyone who's not right for a funeral bond?
Good question. I mean, I would probably argue that, everyone's going to die, so we're probably going to have to pay for a funeral at some point. If you're kind of borderline around getting some age pension or not, maybe you'd consider it. Or, if through a few combination of strategies, like the sort of thing we've talked about, it can increase your pension eligibility, and that's important to you, then you'd consider it. If you're someone that's so far and away from the limits and you're not going to get a pension anyway, well, then really it's probably just a personal decision of, do I want something set aside that my family can just hand to a funeral director and forget about, or am I happy for them to have to go and pull the money out of my bank account to pay for the funeral?
I'm going to answer that. I'm going to have a crack into, let's say anyone with assets above 500,000 combined, really it's not a bad idea. Even if you've got $2 million in a superannuation account, we've had a client pass away with that sort of asset position, and one daughter was overseas, one daughter was in Aussie. Client had passed away. And it was kind of nice because there was also like a mechanism of the funeral director, which was then the funds came, they knew what to do, and they could kind of project manage it a little bit as well. If you are thinking about it, if this is you and you're, above that threshold and it doesn't really that applicable, it's kind of nice to have a very clearly written will and also a funeral bond as well, because Dad looked after us. He didn't tell us he had this, but now we've got this nice funeral bond and we don't have to worry about that. So it was actually quite nice for the kids, the daughter that was in Aussie, who was the executor of the estate, to go through that process, to have that sort of like, oh, okay, so this is what I have to do. And okay, so because they do it all the time.
Yeah. Yeah. True. Cool. Another thing I just actually thought of on the fly that's worth brief discussion while we're talking about assets tests for Centrelink.
Yep.
I won't go too long on this one, but this is more of a trap to be aware of and just something to be careful of. If you're someone that has an investment property with debt attached coming into age pension age, there are some very good mortgage brokers and very good loan writers out there that may structure things in a wonderful way. And then there are some that will just cross-collateralize everything and can cause some problems. And when I talk about cross-collateralization, what I'm talking about is you've got your house that you live in, you bought an investment property, and they've used both of those properties for the security for the investment property. So they've attached a mortgage to both properties to lend you the money to buy the investment property. Now, why that's something to be really careful of is when you get to pension age, if you've got an investment property with a debt attached, Centrelink will look at the value of the property minus the value of the debt, which is rational. That makes sense because this asset value isn't worth the value of the property. It's worth the value of the property less what I still owe on it. However, if my loan writer or my mortgage broker has collateralized my investment against both my home and my investment, Centrelink are going to apportion the value of the debt across both properties, which means that I'm going to end up getting assessed on a higher level of my investment property than what I would have if it was structured nice and clean. So something to be aware of.
Yeah, and the reason why you do that is if you didn't have enough cash initially to fund that, they'll only do it is if there's just not enough assets. The asset pool on the investment property is not enough.
Yeah.
So you just basically take the family home usually, and just that's usually with no mortgage. This is usually sometimes 95% lend, and to get it up to say an 80% lend, they'll use the family home as collateral. Yeah. Hopefully over time there's been enough asset growth that you can actually unwind that cross collateralization without actually doing a cash movement.
Yeah.
It would be a new refinance. You could talk to your broker about that.
And substitute security, all sorts of stuff. There's stuff that can be done, but you just don't want to get to that point and have not consider it because it does catch people out.
All right, guys, we're at the 36-minute mark. So we appreciate you. If you are still here, we appreciate you watching this video so much. We've had a huge growth in subscribers recently. So if you can hit that subscribe button as well. If you're not, we see you, we understand you. We go through the comments and I've had a few sassy responses to people of calling, the number of people that want to call the superannuation system a scam. I think that's like the SSS. It's just a tax structure. It's just like an investment bond. It's just like, there's so many different options. It's a structure.
Yeah.
Take advantage of it.
Easy. Yep.
That's it.
Look, bonus tip on the way out the door. If everything we've spoken about today still doesn't help you get any age pension, consolation prize, don't forget to apply for the Commonwealth Seniors Healthcare Card. A lot of people aren't aware of it. It's a simple income test. For a couple, you can earn up to $161,768 a year before you are not eligible for that card. So most people are going to be eligible.
How old do I need to be to apply for it?
67, age pension age. Consolation prize, still get your cheap doctors, PBS, bulk build medical, all that sort of gear. There's your bonus tip. I'm going to shut up now.
So when you have your birthday, that would probably be your first thing. Put it in the diary.
Yep. Get to it.
All right. Thanks, guys. See you next time.
Done. Cheers.